So we're absolutely delighted to have Bill Smead here with us today. Bill Smead is the founder and chairman of Smead Capital Management, and he created the firm's investment discipline. As chief investment officer, he's the final decision maker for all investment decisions in the firm's domestic equity portfolios. He has over 38 years of experience in the investment industry. He started his career with Drexel Burnham and Lambert in 1980, later working at Oppenheimer and Company, Smith Barney, and Wachovia Securities. Bill Smead received a bachelor's in economics from Whitman College. Thank you for joining us today, Bill.
Thanks for having us.
Excellent. So how about we begin with you just talking a little bit about your investment philosophy?
Well, the backbone of everything we do is our 8 criteria for common stock selection. And there's about 5 qualitative aspects, like balance sheet and moat and historically profitable and consistent free cash flow generation. There's a couple of valuation triggers in there. We like to buy, at John Templeton's point of maximum pessimism, on very meritorious companies, and we like to buy when there is substantial insider ownership, preferably with recent purchases. Nothing we like more than buying alongside somebody that we know has demonstrated wisdom over the past. And the number one thing, which should not be discounted, the company has to meet an economic need. And boy, just think of all the money that wouldn't have been wasted if people had just given that the test.
And can you speak a little bit about how you came up with that criteria? Was it from past readings you did? Was it from past mistakes you made? How did you come up with those 8 criteria?
Yes and yes. This is going to sound terrible, but it all started back when I was handicapping greyhounds, working swing shift, 4 o'clock in the afternoon to midnight, and handicapping greyhounds in the mornings and sending bets over with my cousins. And there were 5 criteria we were working off of to select greyhounds. And Charlie Munger will tell you that one of the keys to investment success is limiting your bets, right? Only waiting until the stars align properly. And that's what we learned to do handicapping greyhound races. And then what happened was I ran into a money manager in 1985 by the name of Barry Ziskin, who took his a fund public in a closed-end fund format, and John Templeton was one of his seed investors, and he had 7 criteria for selecting stocks, 6 good ones and 1 bad one. And I looked at the good ones and I thought, hey, that's what I ought to do. I ought to do the same thing with selecting stocks that I did selecting greyhounds. And so we used some of his criteria, and then we eliminated one of his, which was he was going to sell automatically if the stock hit 20 times earnings. And of course, stocks were a lot cheaper in 1985 across the board. And 20 times earnings then sounded like 35 or 40 times earnings does now. But we added a few things that he didn't have that were more Buffett-esque, more Peter Lynch, more Buffett-esque, more John Neff and other wise people. So what we wanted was a combination of qualitative factors and then a series of value-related criteria.
Yeah, I think that makes a lot of sense. And can you speak a little bit about your time at Wachovia, maybe some of the key lessons you learned there?
Well, that was a hybrid business where we were paying the rent and the staff and the employees, but we were under the umbrella of a larger firm, and that laid the groundwork for starting this company. Because once you've run a P&L and you're going to start a new company, you're used to having a P&L, a profit and loss for the business. And so then I got lucky at church. I ran into 2 ladies that were running the operations of a significant money management firm in Seattle, and they were interested in making a change. So they came and joined me. So I had 2 fantastic operational people, a chief operating officer and a chief compliance officer, right out of the gate.
Yeah, and how do you analyze management as well?
Well, we don't analyze management as much as we analyze what they're doing with their own money. So if I know that the CEO and the CFO of the company are buying the shares right now, then I don't have to wonder if what they're telling the public is genuine or disingenuous. So we watch the insider purchases and sales quite closely. Now, let me give you the opposite example. We own Amgen. It's a wonderful company. It's a huge company. It's like, I don't know, $140 billion market cap. It's based in Thousand Oaks, California, which is a very expensive area of the country to live in. In the last 2 years, there's only been like $6 million of insider sales. So that means that people at work there really believe in the company, and we like that.
Yeah, absolutely. And can you speak a little bit about, I think one of your current holdings is Macerich, and I know there are some concerns, if you read some different articles and things that people were concerned that they might go into bankruptcy or they might have some issues with the debt. How did you sort of get past these issues? And it ended up being a fantastic investment, of course, but how did you get past these types of things?
Well, attractive suburban real estate is getting more and more attractive by the minute, regardless of what you use it for, as the millennial population, which is 90 million strong in the US versus 65 million in the prior age group, spreads themselves out across the country. In the last 10 years, they really concentrated themselves in the expensive coastal and large city metropolitan areas of the United States, which means they were renters, they were single, they spent a lot on rent, they paid their taxes, and they had a huge amount of discretion on their money. Well, now they're getting married, having kids, and moving away to less expensive places to live. And that first move is to move way out into suburbia. And as soon as you move way out in suburbia, your shopping experiences move from downtown metropolitan areas to suburban shopping areas. But also the need for apartments and housing moves away. And just because you've got a suburban property and maybe your Sears store has gone out, doesn't mean you can't build a 250 unit apartment building on that location where Sears does, which automatically provides shoppers to the restaurants and businesses in your shopping center.
And is the thesis for Simon Property Group similar, and do you believe that it's still trading at a discount to NAV today?
David Simon is probably the Warren Buffett of the commercial real estate world. I think the guy is absolutely rock solid, and he's been buying huge amounts of his own stock. He and his uncle own a ton of it already, and that stock looks incredibly attractive in here. They are the largest mall owner. They own the premium outlets. So whenever you go by an outlet mall and it says premium outlets, that means you're dealing with Simon. And then they own a big chunk of Authentic Brands, which is buying up what people think are dying retailers. And because they're the landlord, they know way more about what these folks are doing and whether it's meritorious. So just using an example, Authentic Brands bought JCPenney. Well, they had $11 billion in sales, and Authentic Brands bought that by paying pennies on the dollar for their debt. So they bought them for a song, and they got $11 billion in revenue. And they're their landlord. So life is good.
Yes, absolutely. And can you speak a little bit about your views today on the energy sector and the role of, let's say, oil, natural gas, coal, et cetera, going forward?
So we had two really neat things happen to us. In April of 2020, Barry Bannister at Stifel Nicholas put out a chart comparing commodity prices to stock prices over 250 years. And commodities were the cheapest relative to stocks in 250 years. So that caused us to be very interested in applying our 8 criteria to the best of the energy companies. Okay. The second thing that happened about a month later is Buffett was doing his virtual annual meeting, and Buffett said, the people that think will make a quick transition away from carbon transportation. And the people that think we'll never move away from carbon transportation are both crazy. And he owns the largest energy utility company in the United States of America. So put those two things together. We're in a bull market in oil that's likely to last 10 or 12 years. Those stocks are way undervalued because they've had nothing invested in them. And all these people have become moralists about their investing and have been pouring money into ESG. And when I'm in a cynical mood, I like to refer that to extra stupid growth.
Yeah, that makes sense. And so what do you find attractive right now in the oil space? Upstream players, downstream players?
We love Oxy in here. In fact, we own 4 stocks: Continental, ConocoPhillips, Oxy, and Chevron. And Oxy looks like it has the most leverage. So let's just say we were running a hedge fund and you started the year this year running a hedge fund. The best possible hedge fund is long oil and short bonds. And what is Oxy? They borrowed a whole bunch of money to buy Anadarko in 2019. And they shorted bonds, right? They sold bonds to buy oil. So they are short bonds and long oil. And by the way, the stock has a market cap right now of about, I'd say $40 billion. And at the time that Chevron bid $33 billion to buy Anadarko, the market cap of Oxy, and by the way, that was at $65 a barrel, not $112 like it is today, $65 a barrel. Oxy was trading at a market cap of $49 billion. So it's got both Anadarko and Oxy, which means it was trading at $82 billion of stock market cap at that time, the two of them. And just now, you're buying that at half the price at $112 a barrel versus $65. It's crazy. It's insane. And it's insane because portfolio managers are embarrassed to show people that they own oil stocks. We're not embarrassed.
Absolutely. And can you speak a little bit about Berkshire Hathaway? That's also one for investments. In terms of, both Charlie and Warner, they're getting up there, and there's some uncertainty about, I guess, how the company will be managed afterwards. And now with such a large capital base, it sort of limits what types of opportunities they can invest in. They have to invest in these very large market cap companies, so they can't get the same returns that they used to get, let's say, maybe 20 years ago. So what are your thoughts on that?
Wonderful question. We just love Buffett and Munger. They've taught us so much. I'll forever be indebted to them for their kindness and generosity and wisdom, just wisdom and wisdom. So we love them, but you've already hit on the main problem. The main problem is the two of them can't, Charlie's better at running Daily Journal because it's only $300 million. So we figured out a number of years ago that it's better for us to pick our stocks than it is to try to make our money through them. So we have been de-emphasizing the stock for, the last 3 or 4 years, not out of any disrespect, but see, Buffett has to pay at least a 30% premium when a wonderful company calls him up and says, hey, we'd like to basically go private. Would you buy us? And we can buy that same thing at 30% less than him. So why? And he's so large now, it's got to be a very large animal. I don't understand why he didn't buy Oxy.
Yeah, that makes
sense. He still could. He should call up Vicky and say, hey, Vicky, you've already got $10 billion of my money. I'll pay you, what's the stock trading right now? 51. I'll pay you $80. And you know what? In 5 years, I think he'd be thrilled he did it. But anyway, he's not going to do that. The point is, it's going to take a whopping bear market and stuff to apply that cash. And there's just so many good things to do in the meantime.
Yeah, that makes a lot of sense. And can you speak a little bit about your views? I mean, you own Discovery. There's a massive shift right now in the media space from cable to all of these streaming platforms. How do you view this going forward, both for Discovery and their new service for Discovery Plus, and also their merger with Warner, and also I mean, how do you will people have just a few services of streaming? Will they have more than that? What are your thoughts on that?
Well, the first thing I'd like to mention is doing something again and again and expecting a different result is a definition of insanity. So we bought into Scripps Network, which owned HGTV, Food Network, and Travel Channel, and they got bought out by Discovery, who basically unscripted television for women merged with unscripted television for men, right? Discovery was Deadliest Catch. Okay. So in the process of merging, Discovery broke below the collar. And so we looked and said, well, gee, this thing is so cheap. We're already taking risk on Discovery. Let's just swap our scripts at a 45% premium to what we paid for it in Discovery. And that was at about, I don't know, $17 a share. So then as time went by, John Malone's loading up on it. We added to it. So then we did fine for a while. And then in February of last year, they became a meme trade. So we sold 5% of our portfolio out in Discovery at $62.50. Okay. But then too soon started buying back the C shares, and now have about a 10% loss on the C shares and a small gain on the remaining A shares. And it's not very different than it was when we started working on it 4 or 5 years ago. They're merging with Warner. So the answer is, I might be crazy, but there's something we sincerely believe. We sincerely believe that the most important thing is the ability to make what people want to watch at the lowest possible price. So in other words, in a weird way, Discovery is the Walmart and Amazon of the entertainment world. Their unscripted television costs 1/10 the cost of making scripted TV and movies. So the biggest problem everybody's got is content. So Warner has a spectacular movie library, and they have HBO and their library, and Discovery has all their wonderful shows over the, you can go back and watch Deadliest Catch from the beginning, and you won't be able to remember how many crab they pulled up in the pot. Therefore, it's good stuff. Okay. So David Zaslav has been the brightest mind in unscripted television. And he started at NBC. He created CNBC. And we're willing to take a shot that he can make a success story out of those. And that on a free cash flow basis, it is incredibly cheap, which is one of our main things. Now they've got to repair their balance sheet, and they're going to generate copious free cash flow. And we think there's a pretty good chance they'll be able to do it.
Yeah, that makes sense. And can you speak a little bit about what other money managers or investors were most influential in your perspective on value investing, in your investing philosophy?
Well, like Munger says, this is one industry where plagiarism is entirely acceptable. So there's certain people like Buffett and Munger that we view the same way we would like the CFO and the CEO of the company buying, right? So we like to be side by side with billionaires like John Malone or Harold Hamm or Buffett and Munger. The pressure on our peers to conform the last 3 to 5 years is the highest it's been in my entire career. Munger calls it, in totality, the wildest euphoria episode he's ever seen. When you're 98, that's a lot of episodes. Okay, so I used to pay a lot of attention to our peers that I admired. In fact, the reason we started our mutual fund 14 and a half years ago was because we were comparing our separate account results from 93 to 07 against the top value mutual funds. But they've had to conform to what they've had to follow the money. And that's not what we're paid to do in the value world. We're paid to get the most future success for the least amount of money. And when you're conforming to the FANGs and you're conforming to ESG and you're conforming to innovation and you're conforming to all these popular euphoric trends, it's a kiss of death.
Yeah, absolutely. That makes a lot of sense. How fundamental of a role do quantitative or keyword screeners play in your investment process?
Well, our 5 qualitative characteristics are, we could buy Continental because we knew how many barrels of oil per share we were getting. So back when oil was 50, we figured we were buying $200 per share of oil, and the stock was trading like $20. Okay, now oil's 112. We're getting $450 of oil at that price, and the stock's at 60. So the truth of it is, the margin of safety is as high now as it was then. In many ways. Now, if you've got that much oil, who the heck cares if you've got some debt? You could trade oil for debt right now as easy as you ever could, because being short bonds and long oil has been the best hedge fund trade in the world.
Yeah, that makes sense. And are there any industries that you feel are outside of your firm's circle of competence?
Oh, well, lots of them. I mean, I got wonderful people that I work with around me, and even though I'm a heavy user of technology for the information I can pull out of it, I'm a technology nincompoop.
And what are some of the long-term economic impacts that you see as a result of COVID?
Well, it powerfully good. It kicked the millennials into the maturation process. I mean, we just had a ton of 22 to 32-year-old people that were in extended adolescence, right? The only thing better than that is going off to war, and I hope we don't have that, but they might get that too. Okay, so all of a sudden you got 90 million people that think it's a good idea to buy a house and a car. So let me connect up a few dots for you. In 1968, 500,000 American troops were in Vietnam. Very expensive. Simultaneously, the federal government passed Johnson's Great Society legislation to substantially expand what the federal government does for the poor. They called it guns and butter. Massive federal liquidity. Well, there was 75 million baby boomers taking 44 million silent generation people's place in the 25 to 40 age bracket. Too many people with too much money chasing too few goods. Well, what did we get? We ended up with 11% inflation in 1981. And by the way, inflation is like a wolverine. It has no natural predator. So an unnatural predator named Paul Volcker and an unnatural predator named Ronald Reagan did the double whammy. Volcker took short-term treasuries to 18%, and Reagan stood down the air traffic controllers within a few months of each other. So they economically and psychologically killed the wolverine. Now, young adults in the early 80s spent the next 30 years running away from inflation, worrying about the calamity that had hit. The people that are currently 30 to 50, they've spent the last 15 years running away from the real estate debacle of 05 and 06 and the financial crisis. If you want to make a lot of money, you run into those debacles. So in 81, you wanted to buy stocks and bonds. In the financial crisis, you wanted to buy houses. You wanted to buy Bank America and JP Morgan when they had 1 million foreclosed homes in 2012. You want to run into the fire. And in the pandemic meltdown in March and April, you wanted to buy the most economically sensitive things, and you wanted to buy the things that everybody thought, oh, no one's going to want to do that anymore. 15 to 30-year-olds are not going to go to the mall anymore. What? The only place they can safely gather, they're not going to want to go? Are you kidding me? So that's the ticket. By the way, back to the 1968. Then in 73, 74, the Arabs embargoed oil. And the best performing stock group of the 70s was oil and real estate, both inflation beneficiaries. And by 1980, that's all anybody wanted to own, was either inflation beneficiaries or young companies that were profitable, that were growing at 30% a year, like CAD/CAM companies. Okay, that's all anybody wanted to own: rentals, their own property, real estate companies, and oil stocks. And the most popular television show on television in 1981 was Dallas, because Dallas was the capital of the oil industry, and Houston were capital of the oil industry. Everybody wanted to know what the richest oil man was doing and who he was having an affair with and who shot him. Okay, so that's what we ended up with. What do we have this time? 90 million millennials replacing 65 million Gen Xers. We have the pandemic war, and we have the war against the pandemic, government spending from here to eternity, $6 trillion. And then all of a sudden, April 1st, the Arabs come along and cut the knees off of the oil industry in the United States. It's a rhyme. We have entered the 1970s. So it's likely in the next decade that oil and real estate will do the best, which brings me to the home builders, one of my favorite subjects, if that's okay with you. We are way overweighted the home builders. We checked this morning. The S&P has like 20 basis points in the 4 largest home builders. 20 basis points. It's 1/10 as big as Apple or Amazon. Okay, so the home builders, they build the only thing that the average Americans can defend themselves against inflation: locking in your rent by being your own landlord. And at the interest rates right now, relative to inflation, the lender is giving them the money for free. 6% inflation minus a 4% mortgage is free on an appreciating asset that locks in your rent. That will be the most popular non-oil investment. Now, very important. This is very important from a securities analysis standpoint. there has been a massive sea change in the home building industry. And that is that they used to be land developers who turned the land over by putting a house on it. And they are now house manufacturers. They don't develop the land like they used to. And leveraging their balance sheet used to be the thing that made them so cyclical. Secondly, it used to be a fragmented industry, but the financial crisis and the depression in housing from 2006 to 2014 crushed the mom and pops and the small home builders. They're gone. They're gone forever. Okay. In 1994, D.R. Horton was the largest home builder. They had 1% nationwide market share. They have 10. We own 3 home builders, Horton, Lennar, and NVR. We have 20% nationwide market share. We build 1 out of every 5 homes. So unfragmenting means scale. Scale means better access to refrigerators and labor. And so effectively, they're like the McDonald's and the Chick-fil-A of the home building industry. And they no longer have the balance sheet risk. They've got spectacular balance sheets. They're gushing cash flow. And this is not 04 to 06. The demand is coming from sheer positive demographics. It's not the stupid people with borrowing ridiculous loans to own 4 houses to try to flip them. It is real people growing up out of their adolescence and buying houses as they get married and have kids. So those stocks trade as if they were the same industry they used to be. So they shouldn't have the same price to book ratio because they no longer are leveraging their book value. And they are trading on book. And the analysts that analyze the company are recommending them based on trading on book. And the analysts and the people that work in the industry, they all still have PTSD because of what happened from 05 to 014. It's too fresh in their memory banks, the same way that Alan Greenspan and all the people that were involved in setting interest rates from 1981 to 2011 were all still trapped in the 1970s to 80s, right? They were all worried about inflation. So at every default point, they were always too tight on credit in each of those cycles because they were afraid of the Wolverine inflation. So finally, after 40 years of not getting bit by inflation, we get into a real inflation episode and the Fed doesn't have the guts to pull the trigger. And now that they got no chance to catch up to this thing. None. There's zero chance that 90 million people with too much money chasing too few goods is not going to create an inflationary era. It's economically and mathematically impossible. And the fact that all I've got is a BA in economics and I can understand that 90 million people is more than 65 million people, that's the simplicity that is required. And the smart people with much higher IQs and many more degrees and PhDs in economics, they don't get it. They don't get it. 36% more people in the age that buy houses who are 5 to 7 years behind their prior age groups. And then, as if they didn't need enough evidence, Progressive is running commercials that try to tell them that they're going to be just like their parents. And they're right. It's so much fun. We can barely stand ourselves.
Absolutely. And you also have some investments in major US banks. Maybe speak a little bit about how you view banks today.
Yeah, it's weird. We're a long only 25 to 30 stock portfolio, but we have a weird hedge in our portfolio. We own American Express, Bank of America, and JP Morgan. And long term, we think very highly of those companies. And when interest rates go down on the 10-year treasury, those stocks go down. But our home builders should go up because it's cheap mortgage rates. They're giving millennials free money. So when rates go up, our banks go up. When rates go down, our home builders go up. Now, the truth of it is, our banks are a bigger factor in the S&P. So for outperformance, the S&P, it's much better for us that rates go down, the home builders go up. But we've got this weird hedge. We got about the same amount of money in those two sectors. And ultimately, what's good for the goose is also good for the gander. Because when the millennials become liability customers of the banks will be more profitable. And let me tell you a secret. A husband and a wife with two kids that need to buy a bigger house, the interest rates won't make any difference in 2 or 3 years. One of the biggest home building boom years of the last 60 years was 1978. We had very favorable demographics like we do now, and the average mortgage rate that year was 10.4%. But inflation was running 8%. So nobody was bothered about borrowing money that's tax deductible at 10% against an 8% inflation rate in an inflation beneficiary asset locking in their rent. And by the way, it's nice for once to be in a market that it's good to have 41 years of history in the markets. Whereas the last 5 to 10 years, people watched something go up and said, oh, this just went up, I'll buy it. And then it went up some more, and they were a genius. That's not the way the stock market works. Ultimately, the stock market moves money from impatient people to patient people. And that will always be true. The stock market was never created for most people to succeed. Most people in their lifetime will suffer stock market failure.
Yeah, absolutely. And how do you analyze pharmaceuticals like Pfizer and Amgen?
Gosh, first of all, our two featured are Amgen and Merck. Merck is curing cancer through immuno-oncology, and Amgen is curing migraine headaches, high bad cholesterol, shrinking tumors near the bone with Xgeva. They're just spectacular. These are spectacular science-based, research funding-based companies that are I just love them. And they're the cheapest relative to the S&P in 20 years. And that's all you need to know. Fat dividends, great free cash flow, great balance sheets, high return on equity. I don't understand why Buffett isn't all over these things.
And how do you know when it's time to start your own fund or family office or that type of thing? And what are some of the issues and the struggles in terms of raising capital and your advice regarding that?
Well, I sat in on a talk that a guy that has wrote a ton of great books on leadership, John Maxwell. Okay. And he basically, he was talking about succession and what creates success in business. And he talked about repeating, right? In our business, we call it beating dead horses for a living. So we're repeating the same thing over and over again. And by virtue of doing that, we're creating a great deal of success. So repeat your question again, and let me connect that up.
Okay, so the question is basically, when do you know that it's time to do your own thing, to start your own fund, and what are your advice for raising capital for the fund as well?
If you have an investment selection discipline that you've proven in some way for an extended period of time to be meritorious, there's never a bad time to start with do what we did. Now, I say that our fund started the second trading day of 2008, and we got bludgeoned for 14 months. We're not market timers. But you know what? Now we have over $4 billion, and the money's coming in every day right now. So again, we'll have our ups and downs, but if you've got the backbone of that meritorious discipline and you're willing to beat dead horses for a living, it's a great thing.
Absolutely. And what are your thoughts about how important an MBA or a CFA is in the investment management industry, and in particular in value investing?
That is a wonderful question, because I asked that exact question of my college friend's father, who helped hire me into the investment business. And I asked him that question in the first letter I sent to him with my resume. And the answer to that, it's the difference between you and you, not the difference between you and your competitors. Who are you? Who are you? What are your strengths? Who are you? And how would that MBA or CFA improve you? And if that's going to match up with what you want to be and who you want to be, and that also could be affected by the investment discipline you want to practice. Ours is a very simple thing of being patient and waiting until 1 or 2 good ideas a year come to us. It doesn't require, there's no quant stuff going on here. Trust me. I always try to figure out what all these highfalutin hedge funds do. You know, the ones that I see weird trades going out like with an hour left to go each day, and think, you know, what are these algorithms and all that CRAP? And I do consider that CRAP, by the way. Okay. So, because as soon as you get a mousetrap that's based on technology and genius, all the other geniuses are going to burn that off. But when you're doing something simple that other people don't want to do, where your main asset is your willingness to hold on for a long time, that's what no one wants to do. No one wants long duration, right? Everybody wants to get rich quick. Hardly anybody wants to get rich slow. So back to personally, my son got a CFA, and it's been very valuable to him in what he learned, but also in the respect that his position in the investment industry commands. I got nothing, but I got 40 years of demonstrable time under the belt. Okay. Again, it's you versus you. That was great advice from this man who was a mentor and a dear friend who passed away in 1990.
Yeah, absolutely. And then for a concluding question, what are some of the most influential events of your investing career?
Wow. Let's see. Well, one of my favorites was in 1984, June of 84. We used to listen to cassette tapes from top money managers, and Jack McCarthy, that ran the Lord Abbott Affiliated Fund, sent out this tape. Treasury rates were up to 14% on long bonds because the economy was booming, and the inflation rate was 4%. And he screamed into this tape recording, BONDS, bonds, and just screamed. So I bought a lot of zero coupon bonds and a lot of municipal bonds and a lot of companies that would benefit from rates going down because of that. And it taught me a lot about how to handle conviction even before people think you're right. Okay. And then, of course, when I got exposed to Berkshire Hathaway in the late 80s and early 90s, I remember when the first shock and awe of bombing Baghdad, January 15th of 1991, I stayed in the office late. I was still a stockbroker at the time. and I was buying the A shares of Berkshire Hathaway at $3,500 a piece. And getting on the Buffett train was a huge, huge positive impact, and laid a lot of groundwork in my stock picking career.
Yeah, absolutely. Thank you so much. This is a really tremendous session, and really appreciate you taking the time of your busy schedule to speak with us today.
Yeah, thanks and blessings to all your students and your audience as well.
Thank you to you as well. Have a great day.
You too. Bye-bye.